That's all good.
Okay, guys, well, here we are. It is Wednesday, November 17th, 2021. And I just want to welcome you. The Kim Ross team welcomes you to this end of 2021 Homeowner Seminar. We hope to have these on a regular basis as a way to get information out to you guys, our clients and our friends and our family. And I'm really excited about the lineup that we have today. So this is going to be pretty casual and informal, but I do ask that we hold all questions for the end. We'll let everybody have about 15 minutes to talk, and then we'll do some Q&A at the end. So you can just kind of write them down as we go. So just a quick introduction. I am Kim Ross from the Kim Ross team, and we service mostly Fayette and Coweta counties, although we do kind of everywhere in the Southern Crescent. Our team is growing. We have a few new team members since this photo was taken. So we are a brand new team, just a year old, and we are really excited to help people find exactly the right house for them. For that stage of their life. So we really focus on finding families their bliss. So thank you guys for joining us, or if you're watching the recording, thank you very much. And I'm just going to move right on to our first speaker. So we have 4 wonderful speakers today. And first up is Lee, and he's with Blueprint Home Inspection. Lee and Brooke, his wife, own this business. They work together, and they are an absolute invaluable resource to myself, to my team, and my clients. Lee is going to talk a little bit about why the home inspection is important for both the buyer and the sellers in a transaction. Lee, is it on speaker view now?
Yeah.
Fantastic. You can take it away.
All right. Well, I mean, first things first, I always like to keep things as simple as possible. And I feel like a lot of buyers, we're going to start with buyers, we'll finish up with a selling point. But buyers, they get overwhelmed with inspections, especially first-time buyers, and even people who are seasoned. Nobody really ever wants to see them because none of them ever actually look that great. It's a lot of pages, it's a lot of detail, it's a lot of information. But what an inspection does is it's a simple tool. It is a total view of the home basically at that time. So it can seem complicated, but it is going to help you understand a lot of different points that I'll break down and why it's beneficial. So when you're a buyer, you, in this market especially, you've seen how many homes. We have clients that they've seen 20, 30, 40 different homes. There's no way you can really start to, you can't even really keep up with them. We have buyers that, you know, they thought a closet was over here, but that was a house that they had seen 10 times ago. And really, with the schedule you're trying to get from work, you're trying to see houses, you've got a lot of things going on in your life. You're sending documents here, you're sending documents there, and it's overwhelming. So for a buyer to have a simple breakdown of a home for what's going on, from hidden defects, major cost defects, safety hazards, and then suggestions that we might have as far as simple repairs, what's causing particular issues, it can be invaluable. And really, a lot of buyers think that a home can technically fail an inspection. But when it comes down to it, it doesn't really fail an inspection. It basically lets you know as the purchaser if you can actually handle what that house has. So can you basically handle crawl space issues? Let's say they can't get negotiated during, before you actually buy the home, and you're kind of dealing with those problems on your own. can you see yourself actually taking care of that? You know, are you willing to take on particular cost, roofing issues, things like that? But you have the breakdown. You know, okay, this is either the house for me, or I don't really think I can handle that, and we need to kind of move on. So when you're buying a house, there's so many things to look for as far as electrical, heating and air, structure. It gets a little mind-boggling at points when you're trying to go through a house. You're only there for a short period of time, and some of the buyers that we have, they haven't even seen the house. You know, they meet us there, and it's actually their first time ever walking through it. So you're having to take in a lot of detail at one point, but we're all human. So a lot of the times you're thinking, okay, my furniture could fit in here. My fridge is not going to fit this spot. The doorway is not wide enough, but you're looking at things that are going to affect you after you move in. You're not looking at all the points that kind of like the house is showing you. So the HVAC, the roof, the attic, crawl space, mold issues, things like that. And that's really what a inspection helps you understand and helps you focus on, with pictures, notations, big red arrows to help you see what's an issue and what's not. That way in the buyer's mind, they can actually say, okay, that's not a big deal. I'm good with that. Let's focus on this. And, you know, we can either keep this rolling, or like I said earlier, we can kind of move on to something else. Now, for a seller, I kind of feel like an inspection is even more crucial at that point. One, an inspection for someone who owns a home can be seen as something that can help them with maintenance, help them stay on top of what's going on inside where they live. Because when you live in a home, you kind of get kind of bogged down with everyday life. You're not really looking at, you know, what your gutters are doing, the wood on the outside of your home. There's a lot of points that maintenance includes, and a home inspection can actually help you see it, focus on it, and you can tackle it one step at a time. And a lot of the times there's issues going on with the home that you just have no clue about. You know, sellers that have homes on basements, crawl spaces, they're not aware of particular things like water intrusion, mold growth, things like that, and the reasons why they're actually happening. So when you have an inspection as a seller, you are learning crucial points about your home. You're learning the points that actually can either make or break a sale, and you are able to focus on them, get them fixed, or at least what you can. I mean, not everybody can afford to fix every possible point on their home, but you can take the points that are most critical and actually create a plan and start to tackle those items and get them to where they need to be. That way, if you put your home up for sale, you're not going to have as many surprises when a buyer comes in, they bring their inspector in. And it happens all the time where there's 3 or 4, maybe 5 things that, you know, they had no clue about, and they get blindsided. So what a inspection can do for a seller is ease all of that and make it to where there's less things on the report. There's more than understanding. There's more working together because everybody is within full knowledge. They already know what's kind of on each side. And Kim, I only had some scribbles of documentation and writing that I did in between inspections.
That's okay. I actually think I like questions after each person now that I'm thinking of it, because I do have a few questions. So
Go ahead.
the first one, first I want to say, I love how you talked about the seller getting an inspection before, especially an older home.
Mhm.
For instance, today's could have been a good idea, but
Yeah.
we tend to, I don't want to say ignore home maintenance, but when it's ours, maybe we don't see it. Our judgment is clouded, right? And it's just it's a good point that we should just be, as homeowners, whether
Mhm.
you're selling your house or not, you should, I'm sure there's lists out there that we could give everybody for home maintenance checks, right? And
There is.
huge advantage to that. What I wanted to ask you first is, what about new construction? Is it necessary to have an outside
It,
inspection?
it actually is, and we've been doing a lot of them lately. And what normally happens is I'm not going to name any builder names, but just take any builder.
Mhm.
Whether they have a good name, bad name, it's their workers. Workers can have good days, bad days. Things cannot get hooked up right. Things can be in a hurry. What builders are doing is it's a business. So they have 20 houses going at one time, and their contractors, let's say the plumber, they're basically slapping in water heaters, one by one. And a lot of the times, I mean, they just don't have time to properly test them. We have a lot of points where the water heaters were damaged in shipment.
Mhm.
We have points where the heating elements in the water heater were faulty. So you have a brand new unit, but yet it's not doing anything. We have HVAC systems that weren't hooked up right, and you can't actually control them from the thermostat. Roofing that kind of goes wrong, damaged shingles, things like that. Because when you're moving into a new home, it's kind of like buying a new car. You don't really want, I mean, imagine buying a car that somebody's keyed. That'd be kind of awkward. So we're going to sell you a brand new Mercedes, but just don't mind the key mark on the left side. That's kind of like new construction. You really want to walk into something that doesn't have that many, if something's broken, that means you broke it after you moved in.
Mhm.
That's okay. But we've had, like I said, HVAC, water heaters, windows that won't open and close, a lot of things that would either cost you or annoy you after moving in, even though it's new construction.
Yeah, so important. I remember, I think gutters too, maybe some gutters that weren't sloped correctly. I don't know, that comes to mind, and like that, things like that.
Yeah,
That
A
human error.
question.
it
I had a
does.
question.
Oh, go ahead,
Go ahead.
Sanyata, you have a question?
Yes. Okay. Hey, this is Sanyetta. Great to meet you guys. This is awesome. By the way, Kim. I actually wanted to ask. So we did do a new construction, and they gave us an inspector report already. And the thing that bothered me was, we were in one of those situations that we did not get clear to close literally until the day before clear to close. So we didn't do the inspection ourselves, like outside. But what I did was I did keep a report from the inspector that they did have come out just in case, anything happened. Everything's been great, so far. But I always wonder, was that a good idea to just accept their report? It was pretty standard. So was that a good idea, or that made me come back and hunt me later?
Well, there's always a chance. I'm not going to say that, nothing's going to happen. But what we like to do in new construction, it can be a pain sometimes, because when you're waiting on a builder, a lot of the times builders, they don't really like having their homes inspected. They will give you a 11-month home warranty. And, you know, basically that's supposed to take care of any problems that come up. But what we like to do is kind of be on call, because we understand that clear to close and when we can actually come in and do the inspection shifts quite often. We had one inspection that was actually delayed about 7 or 8 times. But I do feel that it's always a good idea to have somebody that you hire. That way you have a rapport with them that comes in, you can talk to them, ask questions, and then it's not only at the time of inspection, but even after. So say a month from now, you know, something goes wrong or you have a question, let's say we did the inspection, you could always call or text us, you know, ask what you want. And, you know, even we've gone back out to check things just to make sure.
Yeah.
I
Alright,
think
well, yeah, it is really important. It really is.
it is.
You know, hindsight is 2020. So
Mhm.
anyone else have any questions, Brenda, or comments?
Not a question, it's a comment. Having
I
your
have a
own
question.
inspector is like having your own agent.
Yeah.
They represent you, not the builder. When a builder has their own inspection done, they're looking out for the builder's best interest. When you have your inspection done in new construction, they're representing you. And I've had situations in new construction. One I can think of that my client was an engineer, so he noticed it himself while we were looking at the house, but there was a wall where the stud behind the wall had been pushed out for whatever reason to accommodate some piping, I believe, and the whole wall bowed. So they had to redo that whole wall because he was not going to accept that, you know, it had to be repaired before move in. And that's one of the reasons that you really want to have your own inspector, because if once you move in, you're not going to get the same kind of response from
The
builder.
builder. No, that's correct. And Karen, quickly, I think you had one more before we have to move on.
Lee, do you check for drainage issues around the property when you inspect the property?
Drainage issues like rainwater issues, or?
Yeah, just especially with new construction, you know, there's not as much greenery and stuff, and just, you know, around the house, do you check that out? You know, the slope of the driveway or anything like that?
We do, and especially with how they do construction these days, where everything is so kind of mushed together. There's not a lot of space anymore in between properties in a lot of these new subdivisions. So drainage, I think, is really important.
Yeah.
We see it a lot of the times where when they put down new sod and the drainage isn't right, and you'll just see sod kind of float away. It happens all the time.
Yeah.
I think that's one of the biggest things, because, you know, like she said, once you buy the house, you're not going to get that proper response that you think you should get. And landscaping repairs aren't cheap.
No, drainage issues are not cheap.
Exactly.
Yeah.
Especially if you have to put in, you know, French drains, site drainage, anything like that. It's not something you want to do.
No. All right. Thank you, Lee. We'll hold off on any more questions until the end. But that was really great. So next up, we have Karen. She's with Home Services Insurance. Again, an invaluable resource to my team, to my clients. I appreciate her as a businesswoman and as a person. She's a really, really wonderful person, and it's always there to help. So Karen, I'm going to let you go ahead and take over the insurance piece.
Well, I'm going to kind of go a little forward because I want to tie into Lee. The inspection is very important. And when I do the quotes for clients for their insurance, and I can do it for the client during the due diligence. It's very helpful if there's any claims on the house, that I can let the agent know, so that when the inspector goes out on houses that are already existing, they can check the area where the claim happened and make sure to their, however they would do to make sure that it was repaired properly and, completely, and, things like that, especially when there's been water damage in a house. I would want inspector to know about that. So that is an advantage of getting your insurance quote while you're in the due diligence. A lot of people don't, because they're not sure they're going to buy it. So they're just kind of putting that off, and it doesn't cost anything to get a quote. And then you can find out that kind of information. So I really recommend that you do that. So I just wanted to jump in and tie that together there, because then you have two team members working on your behalf in deciding about the house and what's going on with it. So I think that's really important.
Really question, can I just ask you, because this totally relates to that. So if there were claims on the house, is that going to affect the future homeowner's quote in any way?
No, it does not. The only reason it could, and I just had this recently with a client, there had been 3 water claims in a 3-year period. So the underwriter that did ask me what has been done to keep this from happening again, what steps were taken from the previous homeowner to make sure that my company is not going to have to deal with water damage claims, since you've had 2. So if there is a record of that kind of activity, that's what'll happen. They won't decline it, but they will ask. And if they don't get a satisfactory answer, then they could say, no, we're going to pass. But other than that, claims only go with you. So, if you go to buy another house and you had a claim, it's going to go on you, but not the property. It goes with the person. And a lot of people don't realize that if they have like a rental property and they have a claim on that, that goes against your primary home too. And all your collect count. So a lot of people think they're separate, and I have 2 claims on this property, but I don't have one on the one I'm trying to insure. That would be 3 claims for me if I was looking at their policy, to quote their policy. So that's something that kind of, I get surprised. People are surprised by that. But the thing about insurance, home insurance, is you have to think sudden and accidental for it to be covered by your homeowner's policy. Okay, so a tree falls on the roof, we have a kitchen fire, no maintenance issues are covered. That's why it's always good to have the home warranty along with it. They pair very well. If you have water damage, home insurance policy will pay for what is damaged. It will not pay to repair what caused the damage. Home warranty will. So to me, they're hand-in-hand tandem coverages that you should have, because then you're basically covered for anything, sudden and accidental or maintenance and outages like that. So, but you have to think sudden and accidental when you're doing that. A lot of people say, well, my neighbor down the street has the same house as me and they're paying $1,200 and I'm paying $1,800. And so they think because it's the same layout, house plan, and everything like that, that their price should be the same. And that's not how insurance goes. It's based on a lot of factors. How close it is to the fire hydrant, the protection class code would be the same in the same neighborhood. But there is a credit factor in there, and any losses that a person might have, that would also be included in their overall insurance score, which is what reflects in the premium being different. So you cannot honestly compare your insurance premium to someone else's. even if they've got the same house on the same street. You know, it could be different. They could have like a really high one, you could have the low one, you know, so that a lot of people are surprised by that. So the dwelling amount, which is the rebuild cost on a homeowner's policy, is the driving factor for everything in your insurance policy. Everything is derived from that dwelling amount. And the dwelling amount, we have software in all our companies. I'm an independent agent, so I quote with 10 different companies. So each company has software where you put in the square footage, what kind of flooring they have, what the shape of the roof is, basement, slab, all these different features. That's why sometimes they'll ask you, do you have the inspection or do you have an appraisal when you get an insurance quote? Because that allows us to get accurate figures for the rebuild cost. Something that's really important about saving money is if your property that you're buying has a new roof, tell the insurance agent that you're getting the quote from, because it can make up to a $300 difference between a 2015 roof and a 2021 roof. It can $300 a year. So that is a big deal. And when he was talking about the inspections, another good thing, if you have updated hot water heater or even if it's just partially updated and partially updated HVAC, that plays into your premium, because those are less things that could go wrong and cause catastrophic events at homes, okay? So that's really important. And you were talking about maintenance before. Insurance policies are a mutual policy, which means a homeowner has to do something and the insurance company has to do something. The homeowner is supposed to maintain their property and the insurance company is supposed to pay out when they have a catastrophic event. So a lot of people, when you buy a house, the insurance company comes out and says, there's a lot of leaves in the gutters, there's trees touching the house, we can't have that, y'all gotta cut that down, clean it out for us to keep the policy. It's because they don't want things like rodents going in the attic, and the trees touching the roof can do that. The rain building up in gutters that are full can damage and lift up the roof. So that's why the maintenance does count and clock in with insurance when you're doing that. Most things are covered on an HO3, which is what a regular homeowner's policy. There are HO6 policies, which are condo policies, which are a little bit different because they're just the inside walls in. The homeowners is the whole property, the whole building, inside and out. And with all the things that have been in the news, I think it's good to know that in a not so happy way that vandalism, riots, falling objects, airplanes, different things like that. If any damage is caused by those, you're covered with a standard homeowner's policy. And now it just seems like so many things are happening that never happened before that it's nice to know. The only things that aren't covered on your homeowner's policy is flood. That's a separate policy that you would get. If you're not in a flood zone, they're not expensive. A lot of people are getting them now just because so many things have happened that haven't happened before. Mold, there is limited mold coverage usually on a homeowner's policy. If you can ask for more coverage on that, if you've got a basement or something, you may want to do that. Usually you can up the coverage. And believe it or not, those rodents in your attic and squirrels or whatever, they're not covered either. So that's one of the reasons you want to make sure you keep all your ways into your house covered up, because you'll have to pay for that yourself. And that, if they're terrible, they'll make an absolute mess of your attic. So flooding, earthquakes, you can buy earthquake insurance. They're not covered. Landslides, mold, and nuclear hazard. Those are things that are not covered. Fortunately, we don't have to deal about the nuclear that much here, but you can get coverage for all these things. They're just more expensive and they're separate from your homeowner's policy. They would, some companies do offer endorsements that can be added, but they're not the core of the policy. It's an extra thing that you would pay to have on there. The rebuild cost does not match the sale price of the house. Okay, a lot of people, well, I'm only paying $322 for it. Why are you insuring it $420, $475? Market value and rebuild costs are two completely different things. Okay, you've seen the market, what the value is done right now. So we have a lot of houses people are paying a lot more for, that the rebuild cost is lower because of the market. And so you cannot be disillusioned. And if I insure a property at replacement cost, and I've done the cost guide and I've done it correctly, the house does not have to be insured to the quote loan amount. Am I right, Donnie? As long as the house can be replaced, that's all they care about. So if you get a quote for insurance and the dwelling amount is a lot lower than you're paying, you're still covered. And most of the companies now, and every policy I write an extra 25% above the dwelling amount. So they're surely covered for anything weird that might happen during the course of their policy period, which is a year. I mean, right now you've seen the building costs go in a 6-month period, skyrocket. So during that policy year, if my house burned down and my cost guide had not been updated, I would have that extra 25% to cover any expenses that were not figured in because they were unknown. We didn't know the building costs were going to soar like they did in that 6-month period. So that's really important. And replacement cost coverage always. Sometimes they'll try to slip in actual cash value, which is ACV for your roof. No. Contents, no. You always want replacement costs. I don't want to have my 10-year-old TV conk out and I get the $200 it's worth for my claim. I want what it's going to cost me to get a new TV just like it. So that's why you always want to make sure you have replacement costs on everything. Okay. And the last thing I'm going to talk about is liability insurance. There's like 300,000 is the common number for a home policy. Liability insurance does not cover you or anyone that lives in that house. Okay. It only covers guests. Yes, they can be family members that come to your house to visit, but they will only be covered. No household members are. Same thing with your car, your liability insurance. The liability portion only covers people in your car that do not live with you. So, you're not going to, if you get injured at your house, the only thing that you might be able to get some money from is medical payments. And that's why most of us quote $5,000 to $10,000 on medical payments now, because that will cover you and any of your family members. So that's just the short, and there's a lot more stuff, but the basics to me, knowing the dwelling amount and what it entails and how we get that amount, we just don't make it up. It's software based. It's not my discretion. It is, which is the way it should be. It used to not be that way. And so you would get a quote from somebody and it would have never covered your house, but you wouldn't have known that. So that's why the cost guide software has become standard with most companies now. But that's it. If y'all have any questions, let me know.
Yeah, I have a couple.
Okay.
The first one is you said that you quote with 10 different companies.
Mhm.
So generally speaking, do all of those companies have some sort of bundling discount if they were to do home and auto with you?
Yes, I only have 2 companies that only do home only. And usually I only quote them their specific loss histories and things like that. So yes, but most of the companies, I also don't write just home and auto. I write golf cart, as the ATVs, things like that. So I'm a full-fledged insurance company, but yes. And if you have a landlord and a homeowners, that'll get you a discount too. So some people are just tied to their auto company and don't want to change. If you add another secondary home or something like that, or a golf cart policy, those things do help with discounts.
And do you do renters?
And if you have an alarm, that reminds me, if you have an alarm system, even if it's a local, like a lot of us have, the Ring and stuff like that, those are discounts. So make sure that you tell whoever is doing the quote for you that you have an alarm system, whether it's monitored or whether you're going to monitor it. You get more of a discount if you have a company monitoring it, but you still get a nice discount for monitoring it yourself with the Ring apps and different things like that. So that's a good discount to get. That and the roof are the biggest discounts.
Okay. Do you do renter's insurance?
Yes. Mhm.
And then just last question, I've had a lot of first-time home buyers, and we are looking at not just the principal and interest, but we're looking at our escrows. So we're looking at taxes and insurance. So that's a huge factor in what people are paying per month. And obviously, depending on their history and the history of the house or the age, that can vary. Generally speaking, is there any sort of cap, I should say? I don't know how to ask this. Can insurance drastically change from one year to the next? Or is there?
If you have a claim,
Mhm.
it could.
Okay, is
But
that
other than that,
the only? I mean, I know inflation, right?
it will go up because of the costs to rebuild. Okay, and sometimes insurance companies will have a rate increase because they had a bunch of losses in the last couple of years and they've got to stay solvent, so they have to charge more premium. So you will, I mean, to be honest, most insurance, homeowners insurance goes up 10%, somewhere in that range every year.
What 10%? And that's good to know. I mean, that's important information to have, because I think some home buyers come in and say, okay, this is what my lender has told me my payment is going to be, but that is not what your payment is going to stay.
Right.
So,
And it will not, your taxes will go up every year too.
absolutely.
So,
Unless something crazy
yeah.
happens, will it reduce?
Right.
So,
Right.
these are just things that as I am talking to clients, and not just first-time home buyers. I mean, if you haven't bought in a house in a while, or if you're buying a drastically different type of house, especially if it's got a lot more things to insure or a lot of taxes, it's something to talk about. So that's why
Well, whenever
other than claims, is there, so it's about a 10% usually somewhere in.
Yeah, and it may not even be that much.
Oh,
Some
yeah.
years it might be like
Right.
6, but I'm just saying on average,
Right.
you can look for it to go up like that. When I do quote my clients, even if it's escrowed, I let them know what the monthly payment is going to be for their budgeting purposes, so that they're not, because like you said, a lot of new home buyers first-time home buyers don't realize the different facets of their home, of their payment,
Correct.
their house payment. So I try to make sure that they do understand that.
Yeah. And I'll say that I don't know if I've necessarily ever, had all of my clients reach out to you during due diligence. I'm sure a lot of them have, but I think this will now be a point for everyone on my team to say, this is why we do it early. And there's a reason behind it, and I think that's a great thing for all of us to know and add. Does anyone else have questions?
Yeah.
Go ahead.
No, it's fine.
Yeah. I mean, it's really good information for all of us. So thank you for sharing. Okay, so up next we have Gene. He's with Edward Jones in Peachtree City. And he's going to talk to us a little bit about the money portion, and setting ourselves up, not just for buying a house, but for our futures, for our children's futures, and how we can goal set. And just from personal experience, he's really good at that. So Gene, feel free to take it away.
Thanks, Kim. Yeah, I've really enjoyed hearing Karen and Lee talk. I bought a house, I know, with Kim about a year ago now. It's been it feels like a lot shorter time period than that. But I know, when it comes to buying a house, I think the big question that when I was thinking about what to say is, I think from a financial perspective, right? When you're looking at a big purchase, a big investment, your house, would be an investment in this case, is where does the house fit in your financial picture? So I know, I might have some priorities. Everyone has their own individual priorities in your life. Whether that's, I want to buy a second house in retirement, or I just want to retire early, or I want to, fund my kids' college, or I want, to give my kids 10,000 at a certain point, whatever that goal is, everyone has something in mind. And a lot of people, that main goal is, I want to buy my dream house as soon as possible, or I want to buy my starter house so I can ultimately maybe get to my dream, or whatever that looks like for you. A lot of people, for buying a house is a big part of that. So I think when you're looking at, the financial aspect of it, I know a lot of that is through your realtor and through what the mortgage, through what your lender says you can afford. But I think and also part of it is just you and your spouse, or you and your significant other, or you and your family, or even just you have to look at it. Well, does it make sense in your individual situation? So I think that's where you start. And I know, when you're, I guess, looking to buy a house, one of the first things that comes up is probably, okay, how much do I need to save for my down payment, right? Of how much is enough? And that's something, honestly, probably a lender, or probably Kim can tell you a lot better than me what that amount is. But the main thing is you need to get that amount and be like, okay, for my I need to maybe do 3%. I'd have a good chance. That might be the minimum I need for a certain loan. Or it might say, well, in this market, you might need to do 10% or a little bit more, maybe save up some more. And that's very market oriented, but you need to have that number in mind. And then you also need to get, talk with a lender and try to get some of the financials of just, okay, what interest rate am I looking at? What are some things I'm looking at, to get all the relevant information? And then you can say, you know what, I think it's right for me. So I know I need the down payment. You might need some closing costs. You need potential for, okay, do I need to fix up this house? If I'm buying one, that's where the home inspector, that's where all that comes in. Well, what costs go into fixing up the house that I can expect on an annual basis? And then I know Karen was just talking about it, but insurance and tax and all of this that goes into it. There's a lot more than this, just your principal and interest. So I know me personally, when I bought a house, last year, I think I was quoted at, our mortgage price was $700. I was saying that is so low. And then, well, you factor in taxes, it was a new build. So I had taxes and insurance and all of that. Now my payment's about $1,000. So that's an extra $300. Or if I didn't have that conversation, I wasn't aware of that, we might be hurting a little bit more because we weren't aware of the added cost, not to mention the things we wanted to fix and things like that. So I think when it comes down to that is, one is having an idea of what the upfront amount is. And when you're looking at that and how it relates to your other goals, you have to say, well, what's the most important thing? When I talk with people, and I think it's a good, I guess, rule of thumb, is you need to have priorities of where at this moment in time, where are your priorities? For some people that might be like, I need to max out my 401k, or I need to put 3% in my 401k. That's my top priority. Well, then you need to do that, right? But for a lot of people that when they're entering the stage of, I'm thinking about buying a house, you have to ask yourself, well, is the house the top priority at this moment? Or is it my retirement? For some people, it says, you know what? Yeah, the house is my top priority. I want to do that. And then I can lower my retirement savings. I can lower some of my other things. I can lower even my living expenses, my lifestyle, to afford whatever I need for that lump sum to start. So I think that's the number one thing, is recognizing that in every situation, there's priorities involved. And I would say at this point, Kim, and you can say that or not, but a lot of times when you're buying a house, well, a lot of times that's a big commitment. So if you're in a situation where the house is the top, where you've done your other things, and now the next step on your list is the house, that's probably where most of your priorities are. We don't have too many people that when they come in and say, yeah, I'm wanting to buy a house, and then they say, but how do I do my 401k contributions the most? Because it's really hard to do that while you're trying to, especially in this market, trying to pull together the funds to buy a house. So once that is your priority, the house, that's where you can say, okay, how can we, with our cash flow situation, how can we have enough once we have the lump sum or whatever we need for that first deposit? How do we make sure we get approved with a lender and go through the lender for that? How do we get approved? And once you get approved, I think another step beyond that is just saying, okay, let me talk with someone that maybe is a financial planner or maybe does finances to say, is this right for me and my family? And then once you get that, or if you feel comfortable with that, that's where you say, all right, let's go all in to get this house. because we know our cash flow situation is going to be stable and we're going to be able to make these payments and we're going to be able to make this work for our family.
I have a quick question. I have a question about that. So
yeah.
do you, I know you're a lot more on the investing side, but
Yeah.
do you have that capability of someone coming in and being like, okay, so these are my 2 goals this year. I'm buying a house and I want to set up my 401k. Let's look at the finances. What can you help them figure out what they can afford if they want to do both?
Yeah, 100%. Yeah, because like you said, Kim, it's not always a game of this is it, this is none, this is it, this is none, right? A lot of times there's a middle ground. So you might say, you know, my house is my priority, but I also don't want to completely neglect saving for my kids, or I don't want to neglect saving for my retirement. So that's where you come in and say, hey, I don't really know what this answer is. Here's what I want. You verbalize that. And then we say, okay, well, let's look at that. And then we have a little graph, or you have something that basically shows you, okay, here's how you can be 100% on track to this goal, but here's how you can be 100% on track to this house goal, right? And then balancing those. I think that's the best way to do it, because life isn't one or the other, right? It's both. Yeah. You just have to have, okay, what I need, if I want to accomplish that house, how do we do that in the grand scheme of things?
Yeah. And a lot of people just don't, I mean, even myself have necessarily all the skills to put all of that and see it. And that's why it's nice to have a third party go, okay, well, this is the situation. This is how I see it. And this is how, ultimately we all have to make our own decisions.
Yeah.
But it is advantageous to have somebody, in your corner to help you make decisions. I have a question about sellers. I think this is really important. Can they, because they have to sell before they buy. Can they take out from their 401k, use that for the down payment and the closing costs for their next house, sell their house? Is there a time period that they can then put that money back in without penalty?
Yeah, correct. So for 401k plans, most likely it depends on the document, but yeah, for IRAs, so any retirement account, whether that's 401k or a traditional IRA, that, are tax savings so that you get tax benefits when you put it in. Any of those accounts in any given calendar year, so in any calendar year period, you can withdraw from that 401k and then put it back in within 60 days. So it's called a 60-day in-service rollover. So that's something where, hey, if there's a need for that, 401ks, most of them can. That depends on the company, because it's a company plan. Most allow that. But in any traditional IRA, so if you roll the company plan out to an IRA, you definitely can there. But most people, if that's an option, if you're saying I have 50,000 or I have 30,000 in my 401k, I might want to do something similar. I want to know all my options. That's where we ask questions like, what outside assets do you have? What are some things that you have? Because there's some options, like you said, Kim, like, that's not something you would probably want to do on your own. You would want to be very careful with that, but it's something that if you bring up, hey, I'm really wanting to buy this, that's where there's an opportunity there where we can do this. Is it going to close in 60 days? Are you going to be able to put it back in? If you can't, put it back in within 60 days, here's the penalty for that, just so you're aware of everything involved. So you go in, okay, I know my options. And then it might be, some situations it's a great fit.
Yeah. And the only reason I bring that up is because I recently had that. And, the thing is that their financial advisor, they were coming from a different state, and he told them what the consequence, what the risk is. Now, in their case, they would never went on the market. They were able to be under contract and basically sold their house. It wasn't a problem. They paid it back, but there is a risk involved.
Yeah.
So it's good to know all of your options, though.
Of course. And I think one thing we've seen a lot is when you're getting ready to buy a house, right? So when you're saving that down payment, or whether you're going from one house to another, a lot of questions I get are, okay, I have 20,000. I'm wanting to buy a house in 2 years. I'm wanting to buy a house in 2 years. This money is my house payment money. So what do you suggest with that, right? In a 2-year frame, what do you suggest about it for that year or 5 years while I'm waiting? And that's a good question, because right now, it depends on interest rate environment and other things, but the typical rule of thumb is if you need it in a year and you're going to need it for a down payment, you're buying probably around a year and a half or less, the best advice we have is, unfortunately, hey, put it in a high yield savings meaning 0.5% these days, put it in something like that. that, but the one thing with that, it's not making much. You're not going to be rich off of it, but what it's doing is it's protecting that capital, right? You know that you're going to look in, if you have 20,000, the next day you're going to have 20,001 cent, right? But it's not going to be worth 19,000. So we've seen that a lot. Where what are some good alternatives? 2 years ago, yeah, there was some really good bonds and good savings accounts where we can make 3% in a year easily. Now, not really an option as much because of the environment. But once we say you needed it in 2.5, 3 years, that's where we could say, well, maybe some conservative bonds might be a little better, but something that pays you a little bit more. But that's, again, a conversation with any of the house money. If it's in the near future, it's all about your time horizon. And that's where with anything that you might need it, or really need this emergency cash, or need this for your house, that's where we say the best place is keep it away, safe, tucked up right now.
Okay, one last question for you. I'm going to get a million different answers depending on who I talk to, but let's just talk first-time home buyers. Let's talk someone just starting their family. What do you recommend that they have in an emergency fund these days? The first step, not like the 6 months, in payment, just that first, little nest that they put away.
When they're buying a house?
Yeah, like before their down payment, like what buffer do you want them to have?
Yeah, sorry, you cut out. Before so the buffer, I would say it depends on one main thing, or a couple of things, but one is the job. So if me and my spouse, if we both have stable jobs, we're both completely happy in our role, and we have a set salary. So we know each month we're taking in 5,000. I'm a teacher, right? I'm a firefighter, I guess. I'm trying to think of, I'm a doctor, I'm a nurse. This is my set schedule. This is my set hourly rate. Mm-hmm. Well, you might need a little less than, say, someone like Kim. I know your income is variable. So we never know what. So for variable income, we need a larger buffer. Yeah. But I would say typically it will depend on the house you're looking at buying, what kind of expenses, what kind of lifestyle you have. But I'd say 10,000 is a good number. Like you said, 10,000 is a good amount as kind of if anything happens, my car breaks down for 3,000, I need a new transmission. Okay, I know we can do that. My car breaks down completely and I need to go get another one. Well, you might can have some down payment money for that. There's those things, and that is probably the typical answer. But again, if someone is used to a completely variable income, both spouses are just then it obviously could be way higher
or low. Yeah, I mean, I hear $1,000 a lot, and I'm like, these days, what is $1,000 going to get you in an emergency?
Well,
I won't even get you 4 tires.
No, and I would say, you could go low ball. I'd say 5, right? In an ideal world, again, and that's in an ideal world. Obviously, when we're looking at statistics and what people have, that might not be realistic for some, right? Yeah. And so I think 1,000 is a good starting point. But once you can get it out, to say 2,000-3,000, you start to have a little bit more comfort. You start to feel a little bit better. And then also knowing when something happens, you might not, you might can just use the cash or use your bank versus, a credit card or something like that. But again, it's all situational. So, but
absolutely.
That's a good one.
And if you're thinking about an emergency fund for a home, if you're a first-time home buyer or someone who's about to buy and you haven't bought in a while, you have to look at the major systems of the home. That's why your inspection is so important, because you can buy a solid house, but if they've got a 30-year RUD in the backyard for their HVAC system, you don't know. It could last you 5 years, like mine did. Or it could go in a year and then you're dishing out anywhere between 6,000 all the way up to 20,000, depending on the size of your house for an HVAC.
Yeah. Well, and I think the thing that you've seen a lot with everyone is, the finances are one portion, but when it comes to, the specific buying, well, you need a lender, you need a home inspector, you need an insurance, you need all of that.
All of it.
And that's where it's like, a lot of times the answer is, do you have a realtor you trust? Do you have this person? You need they're the expert on that, right? But yeah.
That actually brings me back to a question for Lee, actually. So Lee, if we have a situation where things are coming up on a house and now the buyer's looking at you, they're looking at me, do you help with the process of finding the specialists if we needed a secondary inspection just for that one specific?
We do. Yeah, we actually do that all the time, whether it's plumbing, HVAC, roof, structural engineer. I've helped you a couple of times. Even if I don't know the specific one, I know enough people to where I can kind of find the right path to go.
That's right. And that's kind of what I wanted to get at, is that we all do work as a team, and it's not always easy, but we typically, I'd say most of the time, find the right people, and it all usually works out. And at the end of the day, the money spent on the inspection, if you do have to walk away from the house, that's a good thing. That means that you made the right decision. If nothing can fail, but if you don't feel comfortable, the nominal amount of money you quote unquote lose by getting an inspection and walk away is so little compared to the problems you might have in that house. So, there's certainly been times where people are like, well, about the inspection. And it's like, you got to get the inspection. It's worth the money. It's worth every single penny, every time, new construction or not. Okay. All righty. Last, but certainly not least, we have Donnie Arrington with Prosperity Home Mortgage. She is going to talk to us a little bit about some program. Oh, where are you? Woo!
Can you hear me?
I can hear you twice. Can we mute something?
3 times.
Oh, God. All right.
Donnie, you're logged in on your cell phone also. I think that's why you're getting the echo. You're logged in live and your cell phone is showing up. Okay, I think.
Yeah, but can you hear me?
Oh yeah, we can hear you.
Okay. Well, the crazy thing was, though, the only reason that I called in from my phone is because I tried to ask Karen 2 questions and I wasn't on mute and she couldn't hear me. So I was like in panic mode trying to go, okay, I got to make sure they can hear me. But to make a long story short, Karen, one thing that I did want to tag on, and I'll kind of go through the whole mortgage process in a little bit, but I think this is a question that is very much needed from you. And one thing that really no insurance agent has ever given me, and I've never asked you that before, but talking about the whole qualification process, et cetera. Obviously, yes, the homeowner's insurance premium plays a huge part in the final payment for the customer. That is one of the last things that everybody kind of comes through, and you beat it in the customer's heads. It's like, look, once taxes are finalized, insurance is finalized, that's when we will know the final payment, your debt to income ratio, et cetera. So one thing that I've always wanted to find out, and I'll ask this and then I'll kind of go on and move on to the whole mortgage process of it. But, we have had instances where homeowners insurance did cause the customer to be a little bit outside of like their debt to income ratio based on their final payment. So if we go and we tell the customer, because that was always the suggestion, okay, if somebody came to you and they had $1,000 deductible and their premium was $1,500 a month, what happens if we bump that deductible to, let's say, $2,500 a month, and it takes their payment down to $850 a month? I mean, when you are looking at if you've got somebody that is very, very minimal and very marginal as far as their debt to income ratio is concerned, and the taxes are what they are, and really your homeowner's insurance is the only thing that can really get your payment and your debt to income ratio where you need it to be, how much of a bump in the deductible does it make as far as the premium goes? And does that, like I said, is it affected by credit score like we talked about before? I don't want you to get too far into it, but I didn't know if there was a standard rule of thumb as far as a percentage goes, or what we could do in that instance to try to kind of salvage something.
You're muted, Karen. Hold on.
When I do, especially when we communicate and you're telling me that it's close, I will quote a $2,500 deductible and up to a $5,000 deductible.
Yeah.
And I tell the clients if we end up having to do a 5,000 to get them into the house and get in there, I tell them to try to get, savings built up, and that they can always reduce that deductible later on. But, sometimes you have to make those steps to be able to get the premium down to get into the house. And there's nothing wrong with that. I mean, if I know that, then I'm going to present it that way from the beginning. But if a client comes back or I talk to the mortgage people and they say, hey, we just need to get it down a little bit, then I'll play with the deductible, and that'll really help.
Okay.
And also bundling.
Quickly, can they change it back? How quickly after closing can they get?
I have people change it the day after the closing.
Oh goodness. Okay.
Okay. So it's pretty instantaneous if they decide to bump it up or down.
Mm-hmm.
Right.
Gotcha.
Yeah, it is. It's instantaneous. And people shouldn't really file claims anyways until the claim is at least 3,000. I say twice the deductible. So a high, to the $2,500 deductible can make the difference, and you shouldn't be filing a claim anyway, unless it's like that, so that you'll have a good claims history, because filing claims for silly things, $2,000 claim here or whatever, that can cost you a lot of premium in the long run.
Right.
Absolutely.
Yeah. So getting back to the mortgage piece of it, I would say I've been doing loans for 22 years. I wish that I could sit here tonight and tell you that there was an absolute rule of thumb for any conventional loan, any FHA loan, VA loan, USDA loan. Unfortunately, there is not. There are multiple options out there. We actually have I think there are 6 lenders in the country that have 100% FHA loan, and we are actually one of those. It's a fantastic loan. The rate's higher, but the mortgage piece of it varies drastically, and it is mainly based on A, credit score, B, loan to value, C, probably debt to income ratio. So, when we have people that will come to us and text us or, email us and say, hey, on X amount of sales price with this much money down, what is my rate? What's my payment going to be? It's impossible to really tell somebody that until you absolutely look at the overall picture. Like I said, credit score is the main driver with anything. So until we really truly pre-qualify someone and we see where that credit score lies, how much they have to put down, their debt to income ratio, that is where my expertise comes into play and says, hey, this is the loan product that you should be in. This is, what your rate will be. Here's where, you need to put money down in order to make sure that you keep your payment where you need it to be. Because what I tell so many people so many times is, we have so many people that come and they say, hey, I want to buy a $350,000 home. I only want to put 3% down. Well, guess what? You absolutely could probably qualify for that. But is that going to put you in a payment scenario where you're going to be comfortable paying that monthly in and out? I tell a lot of people, seriously, most people can qualify for more home than what they want to pay for. And so, it's really important to make sure that you kind of back into that situation. And if they want to buy a $400,000 home and they qualify for it and they're comfortable with the payment, absolutely 100%, let's go that route. However, if they only want to pay X amount of dollars per month, that $400,000 payment or sales price with X amount of dollars down will not give them that payment. And that's why you have to make sure that you are very, very hands-on with each customer, or make sure, going forward, because they're going to be the ones that have to pay for this. It's not me, it's not Kim, it's not anybody else in the whole scenario. You got to make sure that they're going to be comfortable. They're not going to be, house poor, as a lot of people say. You need to make sure that you put them in the right loan product, the right sales price, to where they're going to be comfortable with it. And like I told Karen, taxes, insurance, all of that comes into play. Right now, I would tell you, as far as maybe just looking at kind of like moving forward, rates, they are projected to go up. And the consensus is that they are going to go up pretty quickly. Granted, right now they are still historic lows. I mean, you've got with A+ credit on conventional FHA loans, you still have rates in the low to mid threes. That is just historically just crazy. But they are forecasted to go up. So, I always, preface that with people, if they're looking to pre-qualify and they don't want to buy something for 4 to 5 months down the road, we have to let them know, you can lock in for 90 days without an upfront extended lock fee. That's one thing to keep in mind. You can go ahead and lock in, make sure you solidify that rate. Go ahead and get your homeowner's insurance policy through Karen. Go ahead. Let's, once you identify a property, let's look at the, the tax standpoint, make sure, because my biggest thing is, and that's where my mindset has always been, I want to be able to give somebody and pre-qualify them and get them in the home that they have their heart set on, they love. But at the end of the day, you've also got to feel good about knowing that you can pay for that and you can sleep at night and you're not going to lie awake going, okay, how in the heck am I going to pay for this mortgage? So, there's a lot that goes into it on our end as well. You can qualify for somebody, but, again, like, Jean talked about earlier, it's making sure that they're going to be comfortable and long-term. It's a good thing and it's a smart thing for them. But, the one thing that Kim obviously knows about that we love to do on our end is we have a buyer advantage program at Prosperity, and it will allow the customer to pre-qualify and go ahead and get committed, underwriting wise, have a commitment letter sent out without a property being identified. And basically what that is they submit all of the normal documentation that would be required from a normal underwriting standpoint. So, driver's license, 30 days of pay stubs, W-2s. If they're self-employed, we have to have 2 years of tax returns, bank statements. But they can go ahead and submit those documents so that they are already committed to the loan from an underwriter. And then once they find the property, A, they already have a commitment letter. B, it's pretty much you can ask for a 0-day financing contingency, which is huge right now in this market, the way, the market has been so competitive. And then also after that, if they've already been committed from an underwriting standpoint and they have gotten that far along into the process, it's a much quicker turn time once they find a property. You got to order title, you got to order, appraisal, but, really from an underwriting standpoint, documentation standpoint, you've really gone down that road. So that is what right now I would absolutely suggest with most people. And we have a ton of buyer advantage loans right now in process. Like I said before, it's really hard for me to sit on the call and say, hey, this is boom, 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 based on the mortgage process, because it is different from one customer to the next. When you think about it, all of your conventional loans, you probably hear a lot of people talk about DU, LP, etc. DU is desktop underwriter. LP is loan prospector. So Fannie Mae and Freddie Mac, who basically back all of your conventional loans, we have to run all of those loans through an automated underwriting system. LP is loan prospector, Freddie Mac. DU is Fannie Mae. If we have somebody who fits the mold, they have the credit score, they have the debt income ratio, they have the loan to value requirements, those investors on the back end that we are ultimately selling these loans to, they quote unquote, if they don't like that scenario, and we don't get an automated approval on that loan, even though on paper and from from looking at it with myself, Kim, et cetera, anybody, if we don't get an automated underwriting approval on that loan, can't do it. Can't do it. You cannot manually underwrite that loan. And that is where there is so much discord, on our end, trying to tell somebody, well, hey, can I qualify for this? We don't know until we get everything. I mean, and when you, obviously it doesn't happen with us that often because we try to do the very best we can to make sure that we cover all those bases. But when you hear about those nightmare scenarios where you have a loan that falls through the cracks 48 hours ahead of time. I had one a couple of weeks ago. It was a conventional loan. She had good credit. Everything was in line. Our automated underwriting approval went from an approval to, we don't like this from a Fannie Mae standpoint, about 72 hours before closing. And at that point, she had to put more money down. And unfortunately, it was nothing I did. She didn't do anything wrong. That's where those automated underwriting systems on our end play such a huge integral part. And you have to be so conscious on our end to make sure that you've got everything in there correctly as far as income, assets, appraisal, et cetera. So to make a long story short, it's a very, very, very convoluted process. Let me say that. But like I said, there's lots of wonderful loan programs out there. Again, we have 100% FHA loan. Rates are still great.
Connie, talk about your amazing VA.
We have a phenomenal VA loan. Thank you, Kim. Our VA, not only are our rates absolutely awesome, but with our VA, we never charge our standard $11.99 origination fee. So on all of our loans, and that's one thing to also preface, a lot of your lenders out there charge a 1% origination fee based on the loan amount. So if you have somebody that goes out and they originate and close on a $400,000 house, let's say, so to speak, they're going to be charged a $4,000 origination fee with most lenders. We have a flat $11.99 origination fee. It doesn't matter if it's a $400,000 loan. It doesn't matter if it's a $70,000 loan. On VA, we do not ever charge that. And also at closing, we also credit back the cost of the appraisal. So the cost of the appraisal on a VA loan is $450. And so when they get to closing, and this will show on all of their loan disclosures that we send out automatically, on the front end once a contract's written, it will show that VA appraisal is going to be credited back at closing. So really, we have hardly any lender fees whatsoever on our VA loan. We have to charge credit report, tax service fee, but honestly, it's maybe $200. Our VA loan is phenomenal. What'd you say?
I can attest to that. I've used it.
Yes. Yes. And honestly, we've always talked about like our second opinion loans and whatever, as far as if somebody goes elsewhere and, we want somebody to kind of give us a shot. Let's see if we can keep it in house, make sure that we keep it here. We know it's all good. It's not going to fall apart at the end of the day. We have gotten a ton of VA loans pulled in from other loan officers, companies, just simply because our fees, rates, et cetera, just kind of blew them away, so to speak.
Yeah, they do. There's just no comparison. I haven't seen.
Well, and I will tell you this from a time frame standpoint right now. Obviously, I think anybody would attest that's in the business. Things have slowed down a little bit, which, is understandable this time of year. You got the holidays coming up. The past year and a half, 2 years, we all knew that really was not sustainable. But, I turned a loan in on Monday and it was fully underwritten as of today. So, one thing that I can say as far as our operations staff goes, we're on about a 48-hour turn time as far as underwriting goes. If you can get, gosh, I mean, if you can go in with a very, very short financing contingency and know that that customer has been fully underwritten, all of their documents have been fully reviewed, et cetera, it's not just a pre-qualification at that point. It is a full-blown, hey, you got this loan, this is all we need, A, B, and C, and it's pretty much good to go as far as a closing goes.
Yeah. Yeah.
Yeah.
And to me, it's a no-brainer. If somebody is really set on moving in the next 90 days to just go ahead and start that.
Oh, sure. Yeah, absolutely. It's a great program to do. Absolutely. It gives not only the customer, the realtor, everybody involved, just a huge peace of mind. Absolutely.
Yeah. Well, really quickly, one of the things I just wanted to tag on was what you were saying about, what people can afford. So one of the first questions I always ask is, what can you afford per month? Let's not forget about the purchase price, because there's so many other factors that are going to play into, and then, have the conversation with the lender that, that's where you want to start. Let's start with where you're comfortable.
Exactly.
I mean, even Chris and I, 7 years ago, we were pre-qualified for way more than what we ended up buying.
And that's what I was talking about.
And that's what you should. I mean, in some respects, if you don't want to be house poor, unless that's, there's a lot of people out here who really want the house they want, and they're willing to make the sacrifices, and that's fine, as long as we are doing our jobs to educate them. So that's right. What this team here is here to do, is to make sure that everybody has those choices. Really,
and that's that is one of the first things, when anybody qualifies with me, that's one of the first things that I have always really focused on and made sure that I asked, okay, you can qualify for this, but what do you feel comfortable paying? Because, especially with first-time home buyers, and even with people who are not first-time home buyers, they may not be really savvy to, okay, well, these are the taxes on this home. This is how much the homeowner's insurance is going to cost, and they may look at it and think, well, hey, I want to buy this much home. And I could say, hey, you absolutely can qualify for that much home. But when they get that loan estimate and they see the payment is $300-400 more than really what they feel comfortable paying, that's where I always say, hey, make sure you do, your research. What do you feel comfortable with? And hey, if you only feel comfortable, paying X amount of dollars per month, you really don't need to go above $350, so to speak.
Yeah, exactly.
Right.
So I recently had a client who just didn't quite understand how much of a difference the interest rate really has on that monthly payment. And we're talking about the difference between someone getting, a 3.25 and just a 4%. There's a huge difference in payment. So just generally speaking, do you ever advise people to go take a look at a calculator online?
Absolutely.
Is there one that you like? Is there one that you prefer?
Our Prosperity app, if they download my Prosperity app, if they direct the customer to me, our calculator on our app is amazing. I mean, it would allow them to play with the numbers and say, okay, well, hey, I like this house at 275. If I know my rate's going to be this, what's my principal and interest payment, et cetera. Again, you're never going to get it totally accurate, because at that point up front, you don't know what the escrows are going to be. If they don't put 20% down, they don't know what the PMI is going to be, but at least it will give them a little bit of, judgment as far as, okay, well, if I know I've got $25,000 difference in sales price, this is about how much I know it's going to be as far as the difference in the payments concerned. So in that instance, Kim, yes, absolutely. I would encourage them to go to the Prosperity website and or like my specific app, because that little calculator on there is phenomenal. It will give them a ton of information as far as the difference in the payment.
Absolutely. And
For
even
sure.
just comparing loan programs,
For sure, yeah.
there's positives and
Yep.
negatives to every program. And
Yep, because the mortgage insurance is different, I
Right.
mean, even with what you and I have been dealing with one of your customers, I mean, we were looking at an FHA loan to begin with. She found a house that was USDA eligible. The USDA loan, the mortgage insurance is the third of what it is on FHA. And so that's why I say you really just can't pigeonhole somebody into saying, hey, here's what your payment's going to be. I have so many people that email me and say, hey, what's the interest rate? What's the payment? That is such a loaded question because there is so much involved in determining what program they're going to be eligible for. And then also, interest rate, mortgage insurance, all of that stuff comes into play.
Yeah. So really quick, I just want to finish up with Donnie. I'm kind of going to speak in her behalf a little bit here, just because it's happened to her and I quite a few times. We have a lot of clients who come to her or I and have really bad credit. So in that case, you're not looking for a lender. You're looking for a credit repair person. And if you need suggestions, her or I can help. Now, that being said, there are certain circumstances where individuals are very close to being pre-qualified. And in those instances, she can run some certain scenarios, if I'm not,
Oh yeah, absolutely. Yeah.
And can help you figure out what is bringing your your credit score down.
Right.
And if we tweak things here or there, she can then project what increase. So, but that's
right.
Not if you're coming in with no credit.
Well, and so the cool thing about that is, like, when we pull in a credit report, we use Credco. That is our credit company that we use. And so when we pull in a credit report, it shows all three scores. And just as an FYI for everybody, on the call, we keep the middle of the three credit scores as far as credit qualifying goes. So we throw out the high, we throw out the low, we keep the middle. Experian, TransUnion, Equifax, whichever one of those three is the middle score, that is what we use as far as their qualifying is concerned with their mortgage. And so if it is below any of the required scores for any of the various loan products, the cool thing about our credit reports is it will show us on the report, hey, this score can come up to this if you do X, Y, and Z. Now, granted, like I've told Kim and we've talked about so many times, if you have somebody who has just been really negligent and they just have not paid their bills, they've got a ton of collections, that's really, unfortunately, not the kind of customer that this sort of little system is going to help. That's really one of those where only time is going to be able to kind of help. If they've got derogatory credit and they have not paid their bills on time, that's not something that's going to be instantaneously something that you can just, kind of snap your finger and, hey, let's pay something down, get it all right, etc. But at the end of the day, if you have somebody who has just maybe had a high credit card balance or two, our credit reports will tell us, hey, if you look at this score, it will come up to this if they do X, Y, and Z. And so Kim and I just had one. Her score came up 51 points because she went and she paid one account down. And so, we went from not having a customer who could do anything to, she's going to be probably closing at the middle of December. So yes, we have different varying levels of ability to work with people's credit. Again, it depends on the history, the derogatory credit, etc. But that is something that is huge in our world. And a lot of people have used it, and a lot of people have been able to go in if they want to work hard enough and they've got the funds available. That's the biggest thing. It's really hard to make that scenario work if you have someone who doesn't have really any assets. If you get somebody that comes in and they need 100% financing, they need the seller to pay all of their closing costs. Looking at a scenario like that and them going down and probably paying $5,000 in credit card debt in order to get their credit score up, may not be the most feasible and logical thing and even possible thing in the world, but that is a huge, huge weapon that kind of we have on our end. And like I said before, Kim and I've got one right now, and it's been something that has really, people that want to work hard and they've, made a few mistakes. They've had some excess debt due to, extenuating circumstances, etc., but they're willing to do the work. It absolutely is a situation where we can work with those people and get them where they need to be. But if it's a situation too, like Kim said, if they're truly, you can look and just see, unfortunately, they've never had anybody who has ever advised them on how to manage finances, and they've just had very, very, very poor credit their whole life. We also have a credit counselor that can work with them. That's really not something that I deal with and really what our forte is, but that's something that we can send them to. And over time, if they want to work hard enough again, and get their score up, that's an option as well.
Absolutely. And I think that's the biggest thing for me as the team leader of the Kim Ross team. I focus really on goal setting for my clients. And that's not just when they're at the point where they can purchase or they're ready to sell. That's even, that's part of the relationship building that I have with my clients. And that is a very important part. And so if you aren't at a place where you're ready, this team right here who's been speaking tonight are certainly the ones to help you achieve those goals.
Yeah. Well, and I will tell you, and I will say this, and I will shut up. I have done this for 20 years, and I have worked with so many people who have been so disappointed because they could not do something when they first, came to me. But they worked their little tails off. They did what they needed to do. They busted their butts, and there is nothing more satisfying than seeing them being able to close on a home. I mean, it's pretty awesome.
Oh, it is. It's absolutely amazing.
Yep.
Well, thank you so much, Donnie, and thank you everybody who spoke.
Absolutely.
Tonight. Guys, are there any other questions? I'm just going to kind of go through my notes because I learned several new things today. So thank you all. That's the amazing thing is like we're constantly learning and real estate as a whole is constantly changing. So, it's important to keep, educated on all of these things. And anyway, thank you for being here. I did have one quick question for Lee, just for some of the buyers out there. On average, how long does it take you to complete your home inspections?
It depends on the house. It depends on the size and, kind of what state the house is in when we're there. But what makes us different, having two inspectors, so my wife and I, our on-site portion normally takes around an hour and a half to 2 hours. And then it could take anywhere from another hour and a half to 3 hours to create the report and get it sent out.
Okay. And then what other services, aside from the basic home inspection, what can we tack onto that depending on the house?
Depending on, we offer radon testing services, thermal imaging scans to show where homes are losing energy.
And mold.
And mold. So indoor air quality testing, which, that tells you basically everything that's in your air at that particular point, from mold spores to, it's gross, but skin cells, pet dander, that type of thing.
Okay. Yeah. And that's a great service to have, and much needed. So, I think that's all the questions I have. Anybody else? Any other questions? Any comments? Okay. Well, this was an amazing hour and a half of just conversation that is so important for all of us. So again, I just want to thank you all for being here, and thank you if you're listening in or watching the recording. And I am going to stop the recording.